Hello, everybody. Welcome back to Bear and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about the latest election results, not from a political standpoint, but from an investment standpoint. As Alex pops open that beer, as you could hear, which, by the way, sounds delightful, right? In today's environment, right? Like this was a pretty stressful, I think, election for Americans. And there's a lot of questions out there around how to invest given the results. And that's what today's episode is going to be about. But before we dive into that, Mr. Collins, I'd like to hear what you just popped open.
This is a men's room IPA from Black Raven. Are you laughing because that's what you grabbed?
Yes. Go ahead.
So, yeah, it's 5.8 alcohol by volume. And it's just a nice, crisp, clear IPA.
Yeah, men's room. It's a pretty good one. That's from the 107.7, right? The men's room show on the end.
So it used to be on the end. It's now on KISW.
Oh, that's right. That's 99.9, right?
Mm-hmm.
Yeah. So for those of you locals here in Seattle, 99.9 is the men's room, but
classic rock,
and partnered with Black Raven and made a great beer, which I think we've had probably beer number 6 or 7 from Black Raven. We should probably branch out, but Black Raven makes a solid beer here locally, which we enjoy. So
absolutely,
definitely check them out. All right. Well, so let's dive right here, Alex. It feels as though you've got a country that after these election results, there are quite a few people that are scared, and you've got on the other end quite a few people that might be happy or maybe excited for change or difference, right? Again, this isn't an episode to discuss the politics side of that. It's more of we're getting questions like, hey, should I change my investing? And so our clients are asking for meetings for that. Go ahead.
Yeah, so there's so much to unpack there. And all of this comes down to one of the fundamental tenets that we talk about when we talk about investing, and that is we don't want to get too high, we don't want to get too low. Like we want to try to eliminate as much of the emotional component of investing as humanly possible.
Because it's difficult right now. It's really hard. I mean, as I just said, and maybe it's just, recency bias, although I'm not exactly sure that probably part of that is recency bias, to be fair. But this was a polarizing election, and, people they're scared right now, given Trump's election, and other people are not scared. They're excited. And so when you've got those emotions going on either side of that can, when you go into investing and your money, that can have you make decisions that may not be in your best interest because it's truly emotional based rather than looking at the actual data behind what's going on.
Well, and we're sitting here 2 weeks after the election, and what we've seen the market, as measured by the S&P 500 here, have steep gains the first couple days. Then it kind of tapered off, and the last week it went way down. Today, so far, the market is up as we near the closing bell here. But it just goes to the conversation around emotions being high, and we're seeing bigger swings as a result of this. And we don't want to give in to our emotions. We don't want to allow, whether it's fear or greed, dictate how we're investing. Our basic fight or flight instincts work against us when we're talking about investing.
And we've gone through this in some version before. When Trump was elected in, was it 16, right? There was a lot of like, holy crap, where did that come from? And people got scared, right? So we've been through this before. This isn't new. It's just, unfortunately, it's so recent that, we're now a lot of people are becoming emotional with their money, which we understand. But keep in mind, when we're talking about investing, are you investing for the next 4 years? Or are you investing for the longer term, right? Most people invest for what, Alex, 60 years, 70 years?
Yeah, I mean, if you're investing for the next 4 years, like quite honestly, you're doing it wrong. Or at least our view is that you're doing it wrong. Especially if we're talking about like retirement dollars and things of that nature. Heck, even if you're retiring in the next 4 years, you still need that money to last you for the next 20 to 30, maybe even 40 years beyond that. So the time horizons that we were looking at when we're talking about lifetime investing is your lifetime. And like, yeah, we can go ahead and try and take as much risk and whatnot out of investing in retirement. And that's good, whether we're in a high emotional state or not, and whether we're elated or not. But at the same time, like, we don't want emotions to dictate the financial decisions for us.
Look, the best investors, right, are in it for the long haul, and they understand how they're investing, the philosophy behind their investing. To our clients listening to this show, and the clients that don't listen to the show that'll meet with us, right? They understand the philosophy. The philosophy that we tend to use is we use a scientific and math based or principle based philosophy, utilizing statistical analysis rather than what we would call maybe gambling, where we're trying to pick and choose what's going to be the best investment in any given year.
Yeah, we're not trying to predict where the market is going. We're trying to go ahead and use solid statistics based philosophy of what has done well over a long period of time and what do we think has the best chance of success over the next 20, 30 years, and invest that way.
So speaking of analysis, right? So I'm going to share my screen here. We've got a analysis of like this is about the S&P 500, and it's looking out how has the S&P 500 done based on party, right? The blue being Democrat and the red being Republican. And I'll zoom in here real quick. Hopefully I can here. So this is again the S&P 500
Ryan,
from
maybe zoom in one more time.
Yeah. January of 1926 through 2023. And so as you're looking at this, right, like over long periods of time, right, let's just focus on the 80s, for example, right, when Reagan came in. So that's the last 40 years. And you can see there's ups and downs and small stints, meaning year to year. But over the long haul, look where it's gone.
Right.
And we've had plenty of episodes talking about trying to time the market, getting in and out of the market, the effects of that. So this isn't an episode of that, because if you did get out of the market and then try to come back in, you miss out on some of those gains, which doesn't make this picture maybe look as pretty. This is staying invested. If you just stay invested, look what happens. And this is both parties.
Right.
Right. So again, and I chose 40 years for a reason here, right? So, Alex and I are in our 40s. So 40 years from now, we're in our 80s, right? So we've even got a longer time horizon than that from an investing standpoint. And that's how we need to look at our finances, right? You need to, from a pure investment standpoint, you need to understand you're investing for the long haul. You're not investing for 4-year periods of time.
Well, and even if you like look at and I like put all of this data under the microscope, like in general, you're looking at um numbers where it is advantageous to be invested, whether there's a Republican or whether there's a Democrat in the White House. And that does not really matter as far as like which one. It's significantly more affected by what the unknowable news of the day was. If we go through a financial crisis like we did in 2008, well, the market's going to be down. If we go through, a time period where we have massive amounts of issues with terrorism and accounting scandals and a .com burst, yeah, that's what led to the 3 down years in a row in the early 2000s. If we've got financial uncertainty, that's what led to 2022. Like we're going to go through these periods, and it's not that like, oh, it's not Biden's fault for 2022. It's not um, Bush's fault or Obama's fault for '08. It's not Bush's fault for the early 2000s. It's not Clinton's fault for the early 2000s. So like those are external factors that really drove where the market was going and had very little, if nothing, to do with the presidency.
Yeah, I mean, sticking with the S&P 500, so I pulled up a chart here. For those of you listening on just, maybe in your car, make sure you check out the YouTube channel because we're giving the visual side to what we're talking about here. But just to kind of give you some raw data points or numbers, right? In 1980, Reagan was elected, right? So 81 down negative 9%, right? And then the very next year, it was up 14%. The year he was elected was 25%, right? So there's some down years there. Was that because Reagan is in presidency, or was it events that were occurring, right? And then we go through and we're looking at 1985. Now all of a sudden it's up 26%. Keep in mind, Reagan's still in office, right? And then just kind of going through more data points here, right? 89, right? This is Bush, the first Bush, right? It's up 27%, right? I'm just picking data points here. If we go to 2001, right now it's down 13%. Keep in mind, there was events that were occurring. What happened in '01, right? 9/11, right? This is the terrorist thing that Alex was talking about. Then you've got when President Obama was elected in '08, right? Down negative 38, but the very next year was up 23. In 2016, that was Trump's first term, right? So 2016, he's elected. Let's go to 2017, right? That's his first year in office. We're looking at 19%.
Yeah. Well, and like one of the things to think about and look at for the '08 crash was, I mean, one of the things that McCain got nailed on was that he said that the fundamentals of the market were in good shape in September. And then we saw the market crash in October.
Yeah.
And like there was a change between Democrats and Republicans. And part of what was the reason for that was given as economics. Now, like I actually agreed with McCain that the fundamentals in September looked solid, and there was additional information that came out afterwards that disproved that. And as soon as we took away mark to market in March of the following year, the market turned around. So, I mean, it's one of those things where there's a very specific event that occurred and like it just happened right around the time that there was an election.
And again, the whole point of today's episode is like, look, we get that it's an emotional time, right? We're not, by the way, Alex and I are not immune to that as well, right? Like we're also emotional, even though people think I'm not. I do kind of every once in a while show one feeling every once in a while. But the point is look, we get it's trying. The point is when we're looking at a financial plan and we're looking at specifically around investing, you're investing for a long period of time. We're not investing for 4-year periods. And whoever's in office, like you have to look at for the longer term. So make sure if you're not working with an advisor, you should be having conversations with this to look at like what is the long-term picture, right? If you're about to retire, hopefully you're setting up your balance sheet so that the market doesn't make or break you.
I can tell you from experience, the folks that Ryan and I have helped through retirement, they are so much happier the less that their income and the less that their cash flow is dependent upon the market.
I've said it before. It's I half joke when I'm actually really serious about it. Like Alex and I, we crush hope for our clients. And what I mean by that is I think a lot of people, they're going through life and they're investing some portion of their money and they're relying upon the market to either make them or possibly break them. And what we're trying to get at is like, look, when you're investing money, you're looking at the long haul, and you should be looking at your entire balance sheet so that you don't allow the market to make or break you.
Absolutely. And so while we're shattering the hope that the market will be the savior, It becomes the strategy that you're employing that becomes your savior, and how you're actually going to accomplish the things that you want to accomplish.
And I think that's the best way to end this episode outside of the question of the day, Mr. Collins.
Our question today is, what is it that you're doing to make it so that emotions aren't dictating what you're doing with your portfolio?
So head over to beerandmoney.net, and at the top of the page, there's either a contact us section for you to either answer that question if you feel like it, or if you have a question for us for either from this episode or another financial topic, that's a great way to reach out to us. Also, keep in mind, if you're listening to this and you're like, hey, Ryan and Alex, you two sound like you kind of know what you're talking about here. I'd like to sit down with you. In the show notes, there will be a way for you to reach out to us and either do an assessment of your own finances, where Alex and I won't see it. It's just an assessment. It's a tool for you to assess your own finances, or a link for you to book on our calendar should we be able to help. As always, we hope this episode was valuable for you. And Mr. Collins,
cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7356717.1. Expiration date November 2026.